This idea that the polar opposites are not being priced in, what does that mean for the dispersion of outcomes on where things can go in the bond market?
So there is a very fair dispersion of outcomes here. And I think Nisha brings up a really important point here that sweep versus no sweep matters a lot. We see that when you look at how the markets responded to election outcomes historically. What tends to be most bearish for rates, specifically the long end of the curve, is that sweep outcome. And that's because the party that's in power will tend to be spending more money. This is true for Democrats, Republicans. It's really very important to how the market's going to consider this outcome, is what it means for the fiscal outlook, what it means for supply, and that's why we see the back end feeling that upward pressure. So to us, the more clear way to trade this rather than purely from duration, what matters a lot for the direction of rates to us is the Fed, the economy. The Fed's still looking to be on this cutting trajectory. The better way to trade this fiscal premium that we see in markets is trading swap spreads. So looking at how cheap we see longer term cash treasury yields relative to things like OIS and SOFR.
How do you think about duration, Nisha? Would you buy at these levels, or do you worry that the 10-year yield would be meaningfully higher a year from now?
No, look, I mean, for our clients at Parametric, especially as we know, there are a lot of clients sitting in very short-term instruments, cash, CDs, money market funds. I mean, we are still going out with the message that this should still be a favorable market for bond investors. And look, I don't think, at least through year end, the Fed necessarily changes course just yet. There is more data that is coming out, from now until the next meeting, another payrolls number, inflation data. But I think if we're assuming that the Fed is still going to want to back to more that neutral rate, more kind of recalibrating rates, I still think you see another 25 basis point cut at each of these meetings. Perhaps the cuts that we're seeing next year might be pared back. But the point being, Sonali, is that for bond investors, this is an opportunity, in our view, to step out of cash and to lock in yields, right? Real yields and inflation-adjusted yields are the highest that we've seen in a very long time. For investors that have been looking for fixed income and allocating to fixed income, I think this is a great opportunity to step out of cash and at least start legging in. Now, from a duration standpoint, I think this is where you play a little bit of the short to intermediate part of the curve. I do think that, especially as we wait to see election results, you could see more volatility on the long end of the curve. Perhaps this is not a scenario where you go kind of extreme long duration, if you will, but this is still a great time to step out at least a few years and lock in what we think is very attractive yields right now.